And we call this the protected index program. This allows you to make money when the markets move up, but it limits your risk if the markets drop.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Uhl. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have two of my favorite guests back on the line, Rance Mashek and Chris Mercer. Today, Rance was telling me that he has a strategy for wealth management and protecting your wealth. And this is something that's near and dear to me and very interesting to learn about. So Rance, I'm going to hand you the mic and I'm going to let you go with it.
All right. So what we want to talk about today is, as I'm getting into this, just want to make sure everybody knows that I'm going to give you some live example here. And this is not a trade recommendation. It's educational. But we want to kind of share this with you. The idea here is, you've got your trading funds, you've got stuff that you're out there working with, but then as you start to build up, you want to park some of that where it's still working for you, but doesn't have the same level of risk. And we call this the protected index program. This allows you to make money when the markets move up, but it limits your risk if the markets drop. And what it is technically, it's actually called a time spread collar. Now, before you get all caught up in that, let's just break it down into two pieces. It's a covered call on a broad market index. Now we're going to do this on SPY, for example. I'm going to do a covered call then, but I'm also going to do at the same time a long-term protective put. So to do that, let me show you a little bit what we're talking about here. So we have here the SPYs, right? We've had, clearly, they've moved up. We've had some little hiccups here and there and all that stuff. Obviously, way back in, last year, we saw the meltdown with COVID, and we've seen some strength since this. Well, what we want to do is we want to protect against these downturns, but at the same time still be able to make money on it. And the way we're going to do this is we're actually going to buy the SPYs. So I'm going to go buy. I'm just going to do a 100 share lot of this. Just buying the stock, right? That's it. And then I'm going to sell a covered call on this. Now, there's questions as to which one. I'm going to go 2 weeks out just because you can do weeklies, you could do monthlies. I'm going to split that. And it just takes, if you're going to do weeklies, it takes more management of it. And I'm talking about a wealth management strategy, something you're going to park a little bit. So in this case, what I'm going to do is I'm going to flip that around here. I want to get the order right here. We're going to do this on a, there we go, Jan. All right. So go back. I had to reestablish this, right? 100. And then we're going to go out like 14 days. And, right now it's trading at 390. So we're going to look at selling, what's a number we're comfortable with. We might want to look at the chart and see, it's been, up here. It hasn't certainly been to 400 yet. So, we pick a number we're comfortable with there. If I were to go to, let's say 396. And so I'm just going to sell a covered call here, right? So now I'm bringing in, on this particular case here, I'm bringing in, somewhere between about 255, right, on this.
So we're just to start selling covered call, which is what investors have done for ages. Nothing special, nothing fancy.
Nothing special on that part of it, right? Okay. But what I'm going to do then is I'm going to go out further here to let's say January, and I'm going to buy a put. Now, what put am I going to buy? Generally speaking, I'm looking to buy somewhere around so if it's 390, times 0.85, about 15%. That'd be 330 would be the option. So I'm going to take about a 15% risk in this, and we'll go out here and we'll look for the 330. Now, the lowest one I have here is 332. So we'll go ahead and do that.
So where did you get that 15% ish number?
It's my rules.
Okay.
It's my rule. But by the way, the rule is, so
The Rance
here's
rules.
the question, right? Let me share that with you, because that's kind of an important element of this. How far out of the money am I going to go? Somewhere between 10% and 20%, right? I mean, my rule actually is to 25, but I don't like taking 25% risk. So I did 15%. I'm going to take 15% market risk on this out till, next year. And in the meantime, by doing this, I'm going to buy that option. And what it's going to do is it's going to put a floor in. Now, this risk graph, because the risk graph is specifically looking at the short term, doesn't exactly show the full picture here. So let me explain what's going to happen. If this stock collapses, like if this is SPY. So if SPY, we have this, big issue, COVID rekindles whatever, and we see a major market drop, I'm able to sell my SPYs for 332, right? Guaranteed between now and January of next year, I have a 332 number that I can sell that for. And that insurance policy is costing me, it's costing me some change, $16. However, what I'm doing now is I am selling the out of the money option for, in this particular case, we're selling it for 255 for 2 weeks. So how many times between now and January of next year could I do that? I could do that 20 times.
Yeah.
Right. So I'm going to bring in a whole lot more. And that's not even counting upward movement of the stock. Right. So we still have upward movement that we can do. And the same rules that you apply to any covered call. If it starts to get up to where it's in the money, you can roll it up to the next strike up, next expiration cycle out. If it drops quite a bit, you could buy that back cheap. So you don't have that obligation over you. If it bounces back, the standard things that you could do with a covered call, you still do here. And manage it just like that. But what you're doing is you're using this premium that's coming in to buy that long-term protection so that if it does collapse, you're not going to lose money in the trade. Right. And so the idea here is, and by the way, I'll share that I know 2 different money managers. This is their primary strategy. They do it on the Qs, they do it on IWM, and they do it on SPY. And what happens is if the market keeps going up, you're not going to make quite as much as you would have if you would have just done the covered call by itself. However, you eliminate the volatility risk of your portfolio because you now have that floor in here to be able to protect yourself. And we call this a protected index program. And, just as a quick note on it, what we're talking about is doing it on, I also have DIA up here, although I'll tell you that IWM works a little better than DIA. So IWM, the Qs, the SPYs, and you're going to buy the put at least 4 to 6 months out. I tend to go to a year, nearly a year to the next leap at least. And then you're selling 1 to 4 weeks out to do that. Now, there is a little bit more managed way to play this. If you're buying 4 to 6 months out, you want to bring in half your premium in what you sell. So I kind of jumped on that one, but let me mention this really quick because it's a little bit more aggressive way to play it. But it is another way where instead of going all the way out to that January of next year, I might go out to something like July or August of this year. And if I do that, let me go out to there. Let me just show it because it is kind of a nicer way to show this. Again, I'm going to go to 335, that same about 15% risk. In this case, I'm bringing in 973. I'm spending 973. So what I want to do is I want to cover close to half that if I can, right? So I'm going to get pretty tight here. And that's where I'd be really tight on this. And my challenge with that is I might get called out. Mm-hmm. So I tend to not worry about quite covering half of it so that I still have upward movement on here. So I'd probably look at the 393 or 394 and be able to do, oops, not that one.
You need a stock on the quantity.
Yeah, I know. There we go. Yep. Thank you. So that's what I'm going to do there. But the idea is just a simple thing. How much time? It depends on what you want to do there. The longer time, you can certainly, it's protected for a longer bit. And don't forget your cost per month. The longer your option that you buy, the put option that you're buying, the cost per month for holding that is less if you buy more time.
Mm-hmm,
right.
Mm-hmm.
And by
I
the
remember
way,
talking about that.
right,
Yeah.
And just as a comment, because time decay doesn't go linearly, right? It accelerates as you get closer to expiration. And one other comment about this: I'm never going to own this option, the put option, on expiration in January of next year. Right? Why hold it during that last like 60 days of time decay? Right? I don't want to go through that. I'd rather sell it and roll up the position. So that's kind of how I'd want to approach that if that was the case. Right? So again, it's just simply buying a put at the risk level you're comfortable with. I'm targeting between 10 and 20%. Buy that put and then sell short-term calls against that to pay for that insurance policy. Give yourself enough room for the stock to be able to move up. And don't forget that the short-term call, you still have all the same adjustment and rolling capabilities you do with a covered call. Mm-hmm. And this is a way to reduce volatility in your portfolio for the wealth management side of this, that money that you still want to work for you, but you want to reduce the volatility in that so that the other money you're out there playing with, and really working, like on our last session, we were talking about straddle plays, making money on, on earnings, either way the stock goes and all that, right? So that's a little bit riskier game. So if you have that you're doing and you want to have a part you're parking that's still working for you, this is a way to be able to do that. And the covered call is more than covering the cost of your insurance for that long-term in the position. Again,
yeah, that makes a lot. I totally get it. So we're doing the traditional investor route of buying stock, buying the index, right?
Yep.
I mean, even Jack Bogle couldn't fight you on that one.
Right.
Buying the index,
right.
Selling the covered call. Some people don't like the idea of selling calls because it limits their upside, but we're doing it in a short-term time frame. The idea is just to churn these calls so we can take the premium and move on. Mm-hmm. And then we're only exposing our portfolio to a 15% drawdown ever.
Yes.
Because of the put.
Yep.
And in theory, we should sell enough of these calls to pay for that put, therefore having free insurance on our portfolio.
You got it. By the way, one other little, when you're talking about the wealth management side of this, one other benefit of owning it, it's not a huge dividend, but SPY is paying out, 1.5 in dividends. That just helps to add a little bit to that, that overall picture. So,
right.
If you're able to set yourself up in this trade to be able to make, 9-10% in a year, which by the way, on SPY, that's the number. It works out about 9-10% a year with that limited risk game. Now you're up, instead of 9-10%, you're at, 10.5, 11.5% because of that extra 1.5 for dividend. Again, this isn't a swing for the fences trade. This is money that you want to have working, but in a protected way.
Yeah, that makes a lot of sense.
Cool
so Rance, you were showing this to us on the Market Gear platform, and we didn't really get a chance to talk about that ahead of time. For the audience out there, make sure you head to marketgear.com/Chris Uhl. That's spelled CHRISUHL. That's me. That way you can get started on Market Gear and you can see everything that Rance was talking about here. 2 weeks totally free, and then 50% off your first month after that. Rance, the more that I see you showing and teaching me inside of the Market Gear platform, the more I really am appreciating the complexity and the amount of work that went into it. But it's not that we're trying to make something complex. It's that we're trying to give the audience and the users more information so that they can make better trades. I had somebody ask me one day, they're like, so what's the difference in Market Gear and my broker platform? And I was like, they work in tandem. Like, in order to do this, to have all this information, your broker will not have this. And that is where, like you were talking about the historical options chains. I can tell you for a fact, Tastyworks has never shown me an options chain that's already expired, without a doubt.
Well, and I'll tell you what, the back testing, the other thing that's in here that's very powerful is the journaling capability, so that you can, by each type of trade you're doing, track your success with that particular strategy and see what's working and what's not. So things like back testing, things like, it has paper trade accounts, virtual accounts. It has the journaling. You can see all of your trades on the chart that you've done in the past on a particular stock. So you can see how that's playing out. Some really good trade management tools within it. So definitely goes beyond what an average broker has. And by the way, it connects to TD Ameritrade and E-Trade and, all these. So it doesn't matter where your brokerage account is. You can connect with the majority of the big boys. At least we can connect to those through the platform. So you trade right where you're trading now with just some more enhanced tools.
That is so cool. And that's why I really enjoy learning from you guys, because you guys are certainly the experts here. And I appreciate your time showing us all about the PIP program, the portfolio, what you call it? Portfolio insurance program?
Protected index program.
Protected index program. Right. Yep. And it's pretty simple, but it can be powerful in your account if you ever need to use it. So guys, thank you so much for coming on the show again today. I really appreciate your time.
Thanks. Enjoy being here, man.
And thank you guys for tuning into today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you liked that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.